My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, I'm going to demonstrate the solution for exercise 1619 in your textbook. So in exercise 1619, I'm going to skip over to the textbook itself and talk a little bit about the data here. The data is provided to us in a little bit different fashion than perhaps we would typically expect, but regardless of how the data is provided, what you need to do is take that data and fit it into the template, that deferred tax computation template that we've been using as a model. So we have Richard's Refrigeration here, and they have three temporary differences we're told about relating to their tax accounting and GAAP accounting. And those three differences relate to some depreciation on buildings and equipment, some prepaid insurance, not necessarily or not life insurance proceeds, but could be casualty insurance or fire insurance or something like that. And then they also have a liability from a loss contingency. We talked about loss contingencies earlier in the semester, and so we will be discussing those again here. All right, so we've got three temporary differences that are identified, and the information that's provided has to do with kind of a balance sheet presentation or a balance sheet perspective on these items. So for example, with the buildings and equipment, at the end of 2013, the buildings and equipment has a carrying amount of $120,000 for GAAP purposes. When we see carrying amount, that is almost always referring to the GAAP basis for assets and liabilities. Tax basis, of course, is based on tax law. So we can see that there's a difference in the book value of the asset, whether we are looking at GAAP or if we are looking at the tax basis for those assets, and prepaid insurance, as well as this loss contingency liability. Okay, in part C of the problem, we're told that our pre-tax accounting income, and remember accounting income is what we've been calling GAAP income, is $200 million, and the problem is kind enough to provide us also with our taxable income of $145 million. In fact, they've already done the reconciliation, but we need to redo the reconciliation, making sure that we capture the information that we need for purposes of measurement and disclosure. Okay, so let's deal with the first element that we always deal with, and that is, are there any permanent differences? In this particular problem, there are in fact no permanent differences that are discussed. There's nothing about municipal bond income, there's no life insurance proceeds from passing of an executive, nothing of that nature. All we have here are three temporary differences. Nevertheless, I'm going to follow the pattern of our schedule that we've been talking about. So I'm going to deal with the permanent differences first. In this particular case, the permanent differences are quite simply 0. Okay, so now I can move on to my first temporary difference, and that relates to the buildings and equipment. And what we're being told here is, here's the valuation basis of the buildings and equipment. And from that, we need to derive what our depreciation difference is. Well, we can see that the difference in the valuation basis for Richard's Refrigeration is $30 million. And since the tax basis is less than the GAAP basis, we know that we must have had an extra $30,000 or $30 million of depreciation deduction for tax purposes. We don't know what the original cost of the asset is. We don't know how many years that the asset's going to be depreciated. We don't know what our GAAP depreciation deduction is, nor do we know what our tax depreciation deduction is. All we know is that in 2013, the tax deduction must have been $30 million more than the GAAP depreciation deduction. That's the only thing that can explain the difference in carrying amount here. And so I'm going to deal with that first difference of depreciation, and it's going to be a $30 million deduction. So I don't know what my GAAP depreciation amount is. I don't know what my tax depreciation amount is, but I do know that tax depreciation exceeded GAAP depreciation by $30 million. And so that means I need to subtract $30 million from my GAAP income as part of the reconciliation to taxable income. The second difference here has to do with prepaid insurance. And what must have happened here in 2013 is that we paid for some insurance policies. However, even though we paid for it in 2013, for GAAP purposes, we are not able to expense that until some future period, probably 2014. That's why it's called prepaid insurance. We paid for the insurance in advance of receiving the benefits of that coverage. That's fairly typical. Think about what you do with your automobile insurance. You pay that every 6 months typically, and you're paying in advance of the coverage. State Farm or whoever you have as your insurer is not going to cover you and then take payment on the premiums. They're going to take payment on the premiums first, and then they will cover your losses. So that's what's happening here. We paid for that insurance in advance of being able to expense it for GAAP purposes. Tax law, however, is a little bit different. Tax law will allow us to write off that insurance premium when we pay it, regardless of when we receive the benefits of the coverage. So if we paid for that insurance in 2013, we get to deduct it in 2013 for tax purposes, even though we might not be able to deduct it until some future period for GAAP purposes. And that's exactly what happened here. We're told that prepaid insurance has a balance sheet carrying amount of $50 million for GAAP purposes, but a zero tax basis. In other words, we were able to deduct all of it in 2013 for tax purposes, but not able to deduct it for GAAP purposes. That is exactly what happened with depreciation. We've got extra depreciation for tax purposes. We've got extra insurance expense for tax purposes also in 2013. And so that's going to be another $50 million deduction. And then the last item here is the liability from a loss contingency. Remember that from previous chapters, a loss contingency for GAAP purposes is recognized when there is a significant probability or a high probability of a loss being incurred. The loss has not actually been incurred yet, which is why it's called a contingency, but there is the probability the loss is going to occur. So we get to deduct that $25 million in this case for GAAP purposes. So remember back in chapter 13 when we talked about loss contingencies. If we determine that a loss is probable, we will accrue the loss, which means we create the liability on the balance sheet and we deduct the cost of that loss on the income statement, on the GAAP income statement. Once again, this is an example of a difference between tax law and GAAP. Tax law will not allow us to deduct that loss until it is actually incurred, until we actually pay out whatever amount is associated with this loss contingency. So here's an example where we have a deduction, $25 million deduction for GAAP purposes, but we get no deduction at all for tax purposes, at least not this year. Now, in 2015 or 16, if the loss is actually incurred, that's when we'll get the tax deduction for that loss. But we're not able to take it in 2013. So that means that for GAAP purposes, we subtracted $25 million in arriving at our GAAP income. However, we cannot deduct that $25 million for tax purposes. As part of the reconciliation process, then, that means that we need to add back $25 million. We deducted it originally from revenues for the GAAP income statement. Now when we are reconciling to our tax return, we need to add that back in. And so we have an addition for that $25 million loss contingency. That's where the $145 million of taxable income comes from. So we've got $200 million of adjusted GAAP income. We've got $80,000 or $80 million in deductions and a $25 million addition. That results in taxable income of $145 million. And so now we can move on to the journal entry. All we need is the tax rate. The tax rate in this particular problem is 40%. And so we can deal with the journal entry. The first part is income tax expense is simply $80 million. Adjusted GAAP income, $200 million, times the tax rate of 40%. That gives us $80 million in income tax expense. Our income tax liability, or our income tax payable, is $58 million. That's taxable income of $145 million times 40%. That gives us $58 million. That difference, $80 million in income tax expense and $58 million in income tax payable, that is a $22 million difference. That $22 million difference, however, is the result of 3 separate items. And we have to keep track of these items individually. So one item is the depreciation. So we deducted $30 million, or we have an extra $30 million depreciation deduction for tax purposes. That results in a deferred tax liability. So I'm going to create a credit entry to a deferred tax liability account for $12 million. The extra depreciation multiplied by the tax rate is a $12 million impact on income taxes. Prepaid insurance was also a subtraction here. Once again, in this particular example, we paid for some insurance for actually paid for some insurance where we were able to take the deduction for tax purposes, but not permitted to take the deduction for GAAP purposes. So the $200 million of GAAP income does not include the $50 million subtraction for prepaid insurance, but in arriving at taxable income, we do get to take the deduction. And so that's another deferred tax liability. Both of these, depreciation and prepaid insurance, are pretty common deferred tax liabilities. They are situations where a deduction is allowed for tax purposes before it is allowed for GAAP purposes. Both of those result in deferred tax liabilities. And again, we take the difference in the expense recognition, which is just $50 million compared to 0. So $50 million times 40% is a $20 million credit entry to a deferred tax liability account. The loss contingency actually results in a deferred tax asset. Here's an example where we were taking a deduction, a subtraction for GAAP purposes before we're able to take the deduction for tax purposes. So depreciation and prepaid insurance, we're getting the depreciation deduction on the income tax return before GAAP. Contingency is a typical deferred tax asset where we get to take the deduction on the GAAP income statement before it's taken on the tax return. And once again, we take that amount of the adjustment, $25 million times the tax rate, that yields a $10 million deferred tax asset. That will force then the journal entry to balance. We have $90 million in debits, and we add these 3 items up. and that results in $90 million in credits. So that's the journal entry, and then we can move on to the balance sheet presentation. And the balance sheet presentation is going to get potentially pretty complex. Remember that we've created a deferred tax asset, we've created a couple of deferred tax liability accounts, and we also have income tax payable. All four of those are balance sheet accounts. Income tax payable, we've talked about numerous times, is going to be a current liability. The prepaid insurance, whether that is considered a current liability, the depreciation, whether that's considered a current or non-current liability, and the contingency, whether that's considered a current or non-current asset, is a function of when do we believe that deferral is going to turn itself around. Depreciation is typically going to be a non-current deferred tax liability. Depreciation is typically a long-term sort of event, and so the deferred tax liability related to depreciation will typically be found in non-current liabilities. The prepaid insurance, that's just a matter of when does management believe that they'll be able to take that deduction for GAAP purposes. If it's next year, if we just paid the insurance 1 year in advance, which would be pretty common. We typically don't pay insurance more than 1 year in advance. We don't have 2, 3, 4, 5 years worth of prepaid insurance. We typically just pay insurance 1 year in advance, which means that we would reasonably expect that we'll get the GAAP deduction for that insurance next year, which is why I've classified that as a current liability here. And then the contingency, once again, we have to exercise our judgment. When do we believe that that contingency will be settled? If we believe the contingency will be settled in less than a year or less than 1 year from our current balance sheet date, then it would be classified as a current asset. If we believe that it's going to take more than a year for that contingency to actually come about, then we would classify it as a long-term asset. And so I've just sort of made the assumption here that that contingency is not going to be settled in 2014, but instead management believes that the contingency will be settled in 2015 or 16 or something like that. And so I've classified this as a long-term asset. These deferred tax asset and deferred tax liability accounts, whether they are current or non-current, is not a function of whether they're an asset or a liability. It's a function of when does management believe that that deferral will no longer be of value. And that's what determines whether it's long-term or current. And finally, just to sort of complete the problem here, we've got GAAP income statement. Our net after-tax income would be $120 million. GAAP income of $200 million minus our income tax expense of $80 million. That leaves us with $120 million of after-tax income. So that is exercise 19 illustrated here with multiple deferred tax items. We've got one deferred tax asset and a couple of deferred tax liability accounts here.